Hello, this is the first lecture in your managerial accounting class, which is related to Chapter 1. And at this point, you should have read the book and gone through all of the chapter examples and then listened to this lecture, and it should help solidify a lot of the information. Objective 1 is to identify managers' three primary responsibilities. And the first thing that you understand after reading this chapter is that there is financial accounting and there is managerial accounting. And this course is about managerial accounting. However, the lines do cross over between the two types of accounting, especially if you're in a small business. The manager's responsibility starts with decision making. And so a manager always needs the information at hand to make a decision. So the first section is planning. Planning involves setting goals and objectives. Then there is directing, and directing involves overseeing day-to-day operations. And then there's controlling, and controlling is evaluating results of operations. So every manager in every business, whether it be public sector or private sector, deals with the three main: planning, directing, and controlling. And the results of these activities require a great deal of information. Let's talk about planning first. Planning talks about setting goals and objectives and how to achieve them. So examples of planning are generating sales, maybe if you're in retail, opening new stores, reducing labor costs, getting out of the private sector world. If you're planning in government, say a city for instance, you have to plan for increased labor costs due to labor unions. Or if you're in healthcare, you have to plan for a change in healthcare law that you have no control over. And that always brings up the word budgets. Everything has a budget, and that's why accountants get that bad name, because they think that we're the ones that require the budget. And actually, having a budget is very necessary with planning, and accountant's role is to really help with that. Let's talk about directing. Directing is overseeing a company's day-to-day operations. Some examples are using daily, weekly sales reports to adjust marketing strategies, using product cost reports to adjust raw material usage, and then also bringing in the governmental and the nonprofit service line businesses. Let's say once again that you're in education and that your daily operations are to oversee faculty and classrooms and students, and you have to make decisions based on enrollments. So those are directing examples. And then there's the controlling piece of the manager's job. Evaluating results of operations against plans and making adjustments as needed. So you always have your plan. And then there are the things that make your plan kind of go south. So here's some examples that are in the book. They compare budgeted sales with actual sales to take corrective actions, comparing budgeted cost against actual cost. Every line of business does this. They look at their revenue actual against their revenue budget and their cost actual versus their cost budget. And then you dig deeper and try to find out what is going on. Let's talk about Objective 2, distinguish financial accounting from managerial accounting, kind of what I mentioned at the beginning. Financial accounting primary users are external, and managerial's primary is internal. And the purpose of information in managerial is to plan, direct, and control, whereas in financial, it's making investing and lending decisions. I have to say, being a CFO in the industry for a long time, many companies blend these two together because they don't have a large enough finance staff to have a true managerial accounting department. So in today's world, the graduate of accounting comes out and they really are expected to be able to do both. So when you read this book and the examples it gives, it's really designated for super large companies in a lot of instances. So it's really important for me as a faculty in accounting to make sure that my students can do both, because most companies are not large enough to where they have that kind of staff sitting around. The primary accounting product for managerial is internal reports, and for financial, it's general purpose financial statements. And what's included? Well, managerial is defined by management, and financial is determined by GAAP. And if you're in one of those companies, like I mentioned previously, a lot of times they're blended, and it's a combination of both. The underlying basis of information for managerial is internal and external transactions that focus on the future. Financials always pretty much looking at what's happened against the historical. The emphasis for managerial is data must be relevant, and for financial it must be reliable and objective. Managerial accountings really require data to be accurate also. So the way we draw the boxes in a textbook situation is really not as reality as once you get out in the real world. The business unit for managerial is a segment of a business. The financial is usually a company as a whole. Preparation for managerial depends on the management needs and the type of business. And financial is annually and quarterly and monthly. Well, I mean, I've never worked anywhere where you don't prepare a monthly financial statement. And then verification. Internal audit looks at managerial. External audit looks at financial. And then the information requirements. Managerial, it says no requirement. This is kind of like a legal requirement or a statutory requirement. Financial, SEC, publicly traded companies have to follow SEC rules. There's GASB if you're government, there's GAAP, there's IFRS. There's a lot of there really are a lot of information requirements. If you're in education, there is a huge amount of regulatory related to that, nonprofit healthcare, etc. Impact on employee behavior. Managerial takes careful consideration in what they present, and then financial's always worried about the adequacy of disclosure, given all the changes recently. Objective 3 is describe organizational structure and the roles and skills required of management accountants within the organization. So here's your typical little org chart. Let's lay it all out there. You have your board of directors, your chief executive officer, then you have your ops side of the house and your financial side of the house. The chief financial officer sits over functions like treasury, controller, which is GL, internal audit, and a lot of businesses now, since SOX, internal audit really doesn't have any line under the chief financial officer like this picture depicts. So most of the time the internal audit goes right up underneath the CEO. Then there's the chief operating officer who's over all kinds of vice presidents. So it depends on what business you're in. If you're in, like an education institute, your operations would sit over academic operations. If you're in healthcare, you'd have all of your service lines, like your med surg, your cardiac, and whatnot. So it really depends on the organizational structure of the type of business that you do. And then once again, if you have an audit committee, your internal audit has a dotted line to your audit committee, which then reports to your board of directors. The changing roles of management accountants. Let's just kind of put them all up there so we can talk about it. Whoops. Let's go back. Sorry about that. There's a huge impact of technology. Let's just list them all to give you my opinion of all of these. You have to ensure that there's accurate financial records. There's planning, analyzing, and interpreting accounting data, and providing decision support. These 4 simple little bullets, the way they're written, is really the crux of the role of a management accountant, and there's a lot that goes on behind the scenes. Technology is the largest impact of what happens in accounting and what data that you're able to get. You want your financial records to be accurate from your financial side of the house. And the planning and analyzing, interpreting of an accounting data is really dependent on the accuracy of that information. And then the management accountant reports, provide some decision support. So if you're in a really large company and you're a management accountant, you're going to be connecting very closely with your financial accountants and make sure that their data is closed and accurate and ticked and tied so that you can move on with it and do what you want with it. The most frustrating thing for any CFO or high-level person in a company is when the management accountant side of the house is producing data that doesn't tie back to the financial statements. So that it really is important for management accountants to understand financial accounting. What are the skills of a managerial accountant? Well, they have to have knowledge of financial, as I mentioned, and managerial accounting data, and they have to have really good analytical skills and critical thinking. And this is not something that you learn in a book. It comes from having business ops background. And you have to have knowledge of how a business functions, ability to work on a team, and really good oral and written communication skills. So you are an accountant. You're expected to understand accounting, and you're expected to be able to take it to a level where you can explain it to people who are not accountants and manipulate and use that data for some business decision pathway and planning and have it be really relevant. Once again, I mention small versus large because I think it's really important for students to understand when you graduate in accounting, if that's where you're headed, or some kind of business degree, if you work in a small to mid-sized company, you're going to do it all. And it's really exciting to be able to do it all. If you're a large company and you move and get a job in a large company, you'll probably peg yourself in one spot or the other. And that's where the really fine lines of managerial accounting come into play. Objective 4 is the role of IMA and its ethical standards. So up to this point, we've talked a lot about GAAP. Now we're going to talk about this IMA. So I put the little website down here for you. And all the links that I go over on my website in the link section on the 202 page. So you can find them all there. This is a professional association for management accountants. Here are the functions. You can get a certification from the CMA. They have practice development, education, networking, and a bunch of other information. So like CPA on the financial side, there's IMA. Here are their ethical standards. You must be competent, confidential, and have integrity and be credible. Similar to being a CPA, when you have to be both in both sets of if you want to be a CPA or you want to be a CMA, they require very similar things. By now you know what ethical behavior is. Do the right thing regardless of the consequences. And my motto is don't take anything from anybody. When I'm in a role of a CFO, I do not accept gifts, tickets, seats at the Stanley Cup, nothing. Keep yourself private. Examples of unethical behavior are allowing reimbursement of false expense reports, manipulating income, performing tasks not qualified to perform. There are many ways to be unethical. Really putting yourself in a spot to analyze data that you're not competent is an unethical behavior. Steps to resolve ethical dilemmas. Always follow your company's policies for reporting unethical behavior. And believe it or not, there are companies out there that don't have a policy for reporting unethical behavior. And once again, my motto is make sure you tell who you need to tell and you put it out there so that if it comes back and you were the one that knew the information and you didn't report it, you can document that you reported it to somebody. If it's not resolved, depending on these policies, discuss it with your immediate supervisor, discuss with an objective advisor, consult an attorney. My opinion is document everything and keep everything. Unethical versus illegal. Not all unethical behavior is illegal, but all illegal behavior is unethical. And I hope that makes sense to you going into your second accounting class. Unethical behavior is dishonesty, unfairness, lack of objectivity, irresponsible. There are unethical behaviors that cross the line, and there's some that seem fairly harmless, but they fall into one of these categories. Let's discuss and analyze the implications of regulatory trends. Regulatory and business. There's a ton of regulation in the world, especially if you live in California. But from this class, where they're really focusing on is SOX. It happened in 2002, and yes, I cannot believe it's been that long, but it really changed the world of a CPA. There's the IFRS, and then there's this new thing, XBRL. So we're going to talk about these, and sustainability and shifting economy. SOX, I'm sure by now after taking Accounting 201, you all know what SOX is. It was meant to restore the trust in publicly traded corporations. It put a lot of requirements on a CEO and a CFO, and in the financial statements, internal control, annual assessment. And I can speak to being a CFO. There are times when you get involved with a company and you step back and you say, do I really want my name on anything related to this company? Because SOX changed the personal responsibility of being a CFO. And it required an independent audit committee. So remember, it was for publicly traded corporations. However, it has intertwined itself into all types of business and been adopted along the way. It increased white-collar crime penalties too. That was the crux of it. IFRS, been talked about for a long time. It's the results of globalization. it is supposed to get consistent reporting standards worldwide. The SEC is still studying IFRS. Here's the website, and it's also on my website, the link if you'd like to go check out more information. Then there is the XBRL. It is a standardized tagging system for financial reports, and it has advantages because it decreases retrieval time and conversion time, and basically it takes certain words and data and tags them. And check out the website and read a little history about it and where we stand in the United States on this. But if you're a management accounting person and this is your love and where you think you want to go, I highly suggest that you get very technical and take a lot of technical classes. Get good at down to the point of being an Excel expert and understanding SQL and whatnot, because the data retrieval and analytics of a managerial accounting is highly sought after. Sustainability and managerial accounting. Okay, these are the things that that we're going to talk about in this section. Oh, let me go back up. What is sustainability? Sustainability means that a company can actually be out there for more than a year and that their line of business will continue on. Social responsibility is that does that company sit in our society with a social outlook and be part of the community and care about the community. And then there's also the triple bottom line where people are used to profit and people, but now there's the whole planet thing. So not only as a company we're supposed to be able to sustain ourselves and be socially responsible, we better be profitable, love our people, treat them nice, and care for our planet. The shifting economy is where the United States have shifted away from manufacturing towards services. You still need to know how to manufacture your own products if you are a manufacturer. You don't want to forget that. Even though you don't do it anymore, you want to make sure you could do it. Service companies also need to make cost information decisions. Healthcare, education, others. Costs are everywhere. You're not just a manufacturer or retailer where cost is important. Retailers need to consider the cost of importing. So now that your things are manufactured somewhere else, when you price your product, you need to make sure that you consider that in costing out your price. Managerial accounting has expanded given all of this. How do you compete in the global marketplace? There are barriers to international trade have fallen, so foreign companies can compete with domestic now. More accurate and timely information is needed. Inefficient organizations will not succeed. And I can speak to that, having worked in several industries, that when you are inefficient and with the economy the way it is, you will be the company that doesn't make it, whether you're a service organization, a manufacturer, or a retailer. Advanced information systems. We're going to talk about enterprise resource planning, lean production, just-in-time, TQM. Let's take ERP first. ERP is a system that integrates a company's functions, departments, and data. So it's not just your GL and your AP and your AR. It could be your patient billing system. It could be part of your admission system if you're an education. It could be your production system if you're a manufacturer. The advantages of having an ERP system is that it streamlines your operations so they all integrate and talk to each other, and you can respond quickly to change, and it replaces separate software systems so they're all integrated. It is expensive, and you need highly technical human resources and the software itself and all of the updates that you need to it and the people that know how to use it and keep it running, and so there's very few companies out there that have a true ERP system when all's said and done. What are lean operations? It's a philosophy and business strategy of manufacturing without waste. Lean operations also come into the service line. Healthcare is very big on lean operations. It's supposed to lower costs and increase the competitive position. Just in time inventory is you manufacture just in time to fill orders, so you don't leave a lot of stuff on the shelf. It reduces raw materials, finished goods, storage costs, handling, etc. The Japanese automotive did this a long time ago, and many manufacturing companies have implemented this. And it requires a good system to know where your product is and your product need and your product demand so that you don't ever not have enough product. TQM is a goal to provide customers with superior product and services. And once again, this is not just manufacturing either. Healthcare is very big with TQM. They want to provide their customers with superior healthcare and services, the best there is out there, the most innovative. And yet you have to keep an eye on the cost. So you continually set higher goals, and you make sure you meet those goals, and you report back on those goals. Then there's the International Organization for Standardization, and that's the ISO. And that is the end of Chapter 1. If you have any questions, please send me an email. Make sure you go through the whole chapter and do all the examples in the chapter and get into your homework in my accounting lab. Thank you.